Thanks for joining us, Pascal.
Absolutely, thank you.
Good to see you. This is the first, it's a first, so it's the first time we've had it in front of our clients and partners discussion on the digital asset space. We put together a series of just 5 questions. We're in the home stretch here of a long 2 days, but I do feel we've kind of saved a most interesting point for last. I want to, before I get into the first question though, I want to read a quote from an AMA, an Alternative Investment Management Association conference I attended in Arizona last year, and it was a speaker that they had that said, digital assets have rapidly evolved from a niche idea into a legitimate alternative asset class that's been attracting attention from institutional investors, regulators, and global financial firms. If you're not aware of some of the firms that have already entered this space, they include Morgan Stanley, JP Morgan, Fidelity, BlackRock, UBS, and that's just to name a few. And we're seeing improved regulation, institutional grade custody, products like spot Bitcoin ETFs, all bringing greater credibility and accessibility to the space. And the final comment that was made, it's a component of modern portfolio construction and alternative asset allocation that's getting hard to ignore. And so that's why we've entered the space. So I thought maybe we could just start off with the first question, which was, 3iQ and you launched the first publicly listed Bitcoin fund back in 2020. I would say the conversation with most advisors, because we weren't in the space, so when the subject came up is, this isn't really legitimate, is it? I mean, let's be honest, that was the conversation we've had. But ever since then, you've launched Ether, Solana staking, XRP ETFs globally, and now you have a big 5 bank in Canada partnering with you on the first bank-led ETF in Canada. So what has actually changed in the last 5 years, in your opinion, at the retail level from an advisor allocation perspective? Not the price action, because we all know that is a whole different conversation. But what have you seen from an infrastructure, regulation, institutional posturing perspective?
So first of all, you said first bank-led in Canada. It's actually first bank-led in the world.
In the world,
congratulations to that.
Thank you for that.
It was a race between you guys and Morgan Stanley. So this is how early we still are, considering that it's just getting started from that perspective. But when we started trying to bring a regulated product to market, at that moment in time, there was still a lot of debates of, the technology was always able to do what it said it can do, but was the demand for the use of that technology going to be needed? So that was step number one. The second was, regulators needed to be educated. They were way behind the ball on that. I will say though, as the years progressed, they went from fighting it to getting educated to then realizing that there's an opportunity. I have to say that most regions have gotten it right. When we could talk about how Canada's codified things and how we've helped educate them and what's happening in the US and others. So I have to say that this is where a clear example where regulation has gotten it right and has helped an industry mature. And the third is like anything. I think yesterday you had a speaker talking about the early internet booms when you had fiber laid everywhere. That's where I started my career, actually, in Ottawa. And back then it was Silicon Valley North. And I saw those crazy days when venture capital comes in and there's too much money and not enough deal, crazy things happen. And that's what happened in that .com bubble, right? It kind of happened to our industry in the early 2020s. And that's kind of gave it a bad rap. And I'll just share a little bit in terms of what's happened. I will have to say that's gone now. So what was happening back then is you had a ton of VCs coming into the space, lots and lots of money, primarily going into crypto. Getting away from the SaaS investment companies because it was a liquid venture, right? So basically, this is the first asset in history where the technology is also the asset, and it was retail-led, not institutional-led. So most asset classes start at the institutional level and make their way into the retail level over time. This really started at retail because it's a whole new market. You had global exchanges, global liquidity. So what was happening was that these VCs, funded by large institutions, would basically invest into anything new crypto, and then basically get it listed on global exchanges like Binance and Coincheck and Coinbase and others, and get sort of their exit pretty fast. And so you had a flood of new projects that were really early stage ventures, like 10, 15 people in a garage who got venture money, who was listed in public already. And so you had this bad rap of crypto saying, I don't understand between this and the other 3,000 things that launched. Regulation has solved this. These projects that have not survived have been delisted globally. And today, the biggest thing that's changed is you have a clear example of which ones are the winning chains and are being adopted by institutions. So that's really the story in the past 5 years. So it's important to look back in history because there was a lot of shenanigans happening, and that has disappeared.
Okay.
Yeah.
It does feel like we're at a bit of an inflection point. We're starting to see more regulatory framework come into play here. You've got the Clarity Act moving through the US. You've got MICA now live in Europe, which is another, I think a lot of people call it one of the more advanced regulatory frameworks, right, for crypto in Europe. You've got JP Morgan now recommending to their wealth managers an allocation of 1 to 5% in portfolios. From where you sit, running 3IQ and now Coincheck, what's driving this moment?
So I have to say it's the demographic change and the mobile revolution. So if we got to think about this, for example, we just came back. We work with global companies. We just came back from Bhutan of all places. They have a lot of hydropower that they can't sell to other countries because it's too expensive to build power lines. So they've been mining Bitcoin with their hydropower as part of a sovereign, a nation building for about a decade now, right? But their challenge there is they have a lot of kids who are leaving to the US, leaving to Australia and other places because they see what the advanced world has on their cell phones, right? You're on TikTok, you have social media. And so long story short, there's a demand for what I would say, the digital US dream. So more and more people in emerging markets have access to the internet and mobile phones and are seeing investment opportunities that they don't have access to, right? We take it for granted here that we have access to US markets, we have access to Canadian markets, we have access to all these amazing products. Most emerging markets do not. This technology is transforming that. And so what's happening is the emergence of stablecoins, right? Stablecoins, we could talk a bit more, but there's been a huge renaissance of that, regulated stablecoins, access and to a flight to safety, so the US dollars. So once you have access to that in multiple emerging markets, you're now what we call on-chain. You're on the blockchain, right? You have the US dollars on the blockchain. What are you going to do with that now, right? You may want to spend it, payments. You may want to start investing it, earning a yield, or putting it into products. You don't go back to your bank and say, I want fiat cash now, because they don't have access to US cash in their emerging markets. They want to invest on-chain. And so this whole advent of tokenization and digital funds is emerging. And so one is user demand. And basically at the same time in what I would call more developed nations is the wealth, the crypto wealth is also emerging. So individuals, the younger individuals in their 20s and 30s who invested in this technology early are now looking for more professional services. They're going to the Morgan Stanleys, they're going to the JP Morgan saying, can you now bank me? Can you now give me access to loans against my crypto collateral? Can I get a mortgage back against these assets? And so you're seeing client demand from the crypto community that are now have a lot of wealth globally, and you're seeing access to emerging markets who are now on chain looking for diversified access. And so you combine these two things together, there's just an uptick in demand, and institutions want to service the markets.
I remember watching the Davos conference about 4 or 5 years ago, and JB Diamond was being interviewed, and they asked his view on crypto, Bitcoin. He said, you'll lose all your money. And now JP Morgan is in the crypto space. Yeah. Is that all part and parcel of what's driving CEOs to be just, when circumstances change, my opinion changes?
Yeah, well, I mean, when enough money, I think, knocks at the door looking for services, right? And I think the big change is, again, the old ethos, and things change over time, right? So I come from the early open source days. Today, open source is an R&D business model that works quite well. But when I started my business 20 years ago, one of my businesses, venture capitalists were like, why would you write free code and give that away to compete against Microsoft? But it was an R&D methodology. So where I'm going with this is crypto in the early days, it was the old, you need to own your wealth and self-custody and protect yourself against all those things. There are still people who want to own those assets and do that. And for some war-torn countries, it makes a lot of sense. But the reality is most individuals want to gain access to the banking system, right? And so when folks like Jamie Dimon and others see a lot of millionaires and billionaires sort of the door with this wealth, they want to service them. And that's just a reality that individuals who are now in their 30s, 40s, and 50s who started early want to diversify that wealth, want to gain access to traditional services, and institutions are diversifying their services to meet that. Okay. It's just where the world is today.
We want to get a little bit into what we've built together.
Yeah.
Before I get there, though, I'm going to ask a question. I never like to speak on behalf of an audience, but I am going to take a flying leap here and ask you the question that maybe, because these are really nice people, that they might not ask you outside over a box lunch.
Yeah.
But you run 3IQ, you run Coincheck.
Yeah.
your whole professional life, your identity, your compensation is wrapped up in this world. I'd like to ask you, though, why anyone in this room should trust your read on where this asset class, which we are calling it an asset class now, is heading. Yeah. What's the strongest argument against everything you've said and are about to say? And what would actually have to happen in the world for you to come back here in 2 years and admit to everyone you're wrong?
Yep. Great question, by the way. So fundamentally, we are at an inflection point now that I would say that we're in a world, and I just did a town hall to the whole team, right? We are now in a place where 5 years ago, we would have dreamed of having, right? I'm at a conference with you guys, right? A bank-led ETF. Institutions are adopting it. The technology is functional. So now it's game time, right? This asset has made it to the NHL, but you got to win the cup, right? So what does that look like? What are the two main risks that I see? And it's no longer regulation that's been solved. It's not quantum. We could talk about that over lunch, but fundamentally, the quantum-resistant, software is being built not just for crypto, but for financial services and other services in general. The main thing fundamentally is, with the institutions coming in and with the engineering that's happening around some of these products, like IBIT is being used for a lot of interesting financial innovation around that product. Is there a world where you get heavy concentration risk? Like, will Bitcoin be owned by BlackRock? Right? Because everyone's buying that ETF or everyone's building around that ETF. Michael Saylor's products are gaining, like MicroStrategy and their debt-based instruments are gaining a lot of popularity with some. Aimco announced recently that they allocated to MicroStrategy, right, as their first entry point to crypto in Canada. And so is there a world where we wake up where the big institutions have a disproportionate ownership of what is supposed to be a decentralized network? That is one potential risk to keep in mind. I wouldn't say it would happen in the next 2 years, but it's something to monitor, and we monitor that all the time. And the second is more around the use case. So again, I talked about individuals in emerging markets and other places looking to use their stable coins to deploy into different products. So tokenization is booming. Do they just want SPY? Do they just want tokenized S&P 500? At which point, you really just have one fund that's tokenized. They just want all access to U.S. equities, or do they want true, access to the tokenization of all these liquid alts or illiquid alts or real estate? Because everyone's talking about real-world assets and real-world tokenization, but do investors actually want that, or just looking for, the S&P 500? That is yet to be determined. So those are the things to look at in the next few years: concentration risk, and do people actually want access to all these different products.
Right.
And if those two things do happen, then the blockchain won't be as used as we thought it would be, right? So far, I would say that the trend is showing that that's not happening, but that is an honest risk to your question, an honest answer to your risk question. Yeah.
Pascal, there's dozens of single asset crypto ETFs out in the market right now. What we've built together is I would call it deliberately different.
Yep.
So we've got exposure to XRP, Solana, Ether, and Bitcoin. Can you talk just a little bit why these four? What does it mean to be actively managed in this particular space? Why didn't we just go market cap weighted? From an allocation perspective, and what are the PMs that are working on this file doing on a day-to-day basis to be considered active?
So I want to give a little bit of a history. We've been working at this for almost a year and a half now together, right? And when we started, there was a vision of let's build something that's unique for advisors, right? Answering the question of how do I give clients exposure to this without having to pick winners. I don't have the time to understand the difference between all these chains. But I want more than just Bitcoin, because if there's something different, so how do I have an all-in-one package? The problem with indexing, market cap indexing today in this space is that you end up with 85-90% Bitcoin, because Bitcoin is still the dominant asset class, and so you end up with really Bitcoin and sprinkles of other things. So you're not really diversified. The fund says you're diversified, but really you just own Bitcoin, right? Yeah. Which is one thing. So and when we started the conversation, you have to think that regulations in Canada were still exempt based, right? So there was Bitcoin and Ethereum available, Solana, XRP, others were not available. That's how early we had these conversations, right? So regulation had to change, and codification of that regulation had to change. And so 3IQ has been very active. We sit on the OSC's crypto committee. We help do a lot of education. So we were projecting with you guys of what's going to happen in the next 18 months. And if the things we think happen in the next 18 months, we'll be able to really build a solid solution for advisors. And those things became true. And so today, everything's codified. 81.102, right, is now clear in regards of what we can or can't launch when it comes to digital assets. And so DXMC is a truly diversified exposure to what we call the picks and shovels to the industry, right? So if you believe in what we talked about of the adoption of stable coins, the advent of tokenization, and some of the equities that are helping make that happen, then this is the product for you. And so these chains that we talked about, so Bitcoin, Ethereum, Solana, et cetera, are part of what we call our active management is diving deep into the use cases. Right? There are some crypto assets in the top 10 that what we call are dead chains. In other words, they are great projects. They gain a lot of retail popularity, but the development on it never happened. Right? So I could give you a fun fact. Like for example, Solana is gaining a lot of traction in emerging markets, where just like how the cell phone industry in Africa, leapfrogged landlines, went straight to cell phones. Emerging markets are building financial infrastructure, skipping the old systems and going straight to blockchain, right? So my team was just in Astana. We are looking at working with the local sort of innovative hub there led by the government. They're looking for tokenized products, right? Okay. But they built a whole new market, essentially a stock market on Solana in an emerging market. So those things are things we want to look at, right? In other words, how active is the project? What is being built? We have relationships with the foundations. We talked about to the teams all the time. And so we want to make sure that, number one, that the chains are actually growing in popularity, not just in terms of users buying it, but actually building something on it. So fundamental analysis. The second is we will talk about convexity in a second, but these digital assets have a lot of convexity, and you want to let your winners ride. And so there is a momentum aspect to the portfolio as well. Yes, they all move in tandem, like crypto is either up or down together, like they are correlated together, but you will all have outperformance out of some of those when there is momentum. And so you want to have some form of momentum-based portfolio, which our team leads as well. And then finally, like I said, it's built for longevity. So the world is changing, right? There are new protocols and really interesting projects that are gaining tons of momentum, that are close to being fully regulated, like Hyperliquid, which is a decentralized derivative platform that's gaining a ton of traction and gaining the interest of some of the institutions. That may be something we want to add. In other words, it's a picks and shovel project, right? So how do we do that? You need to have a team that's always looking at what's happening and then have an honest conversation with the team. So DXMC today is actively managed on the fundamental level. It's basically actively managed at the momentum level, and it's also built for longevity.
A lot of the people in this room and that we've met over the last couple of days, and a lot of who we deal with at Dynamic are, certainly on the fee-based side, but are discretionary portfolio managers themselves. Yep. They have IPS constraints. They have suitability obligations. They may be with dealers that actually haven't accepted this yet into model portfolio solutions or allocations. Yeah. They also, probably some of them would have clients that range anywhere from the skeptical yep. to maybe already over allocated to the space in their do-it-yourself accounts, whether it's InvestorLine or whatever. I know my own broker said if I wanted exposure, go to Scotia iTrade. He wouldn't touch it. But I think that's changing. We're seeing allocations now in Fidelity all-in-one portfolios. Yep. I just saw a LinkedIn ad this morning that talks about and a little bit of Bitcoin or a little bit of the digital assets. So practically, and with DXMC in particular, our mandate, how should the advisor be thinking about allocation, and where does this fall within the equity and alternative sleeve of a portfolio?
So this is still one of the number one barriers that's happening in the industry worldwide. Yes, you have big names starting to make recommendations on portfolio sizing, and then basically research as to why. But no one's really trying to inject it into portfolio theory. This is something we're trying to solve by saying, okay, what is the thesis? And so we just have a white paper we just submitted and doing a lot of research papers out there, but we're trying to promote the convexity aspect to it, right? So now, we're not here to say that crypto is uncorrelated. I mean, as things become more and more adopted, there are moments where it's becoming more and more correlated to equities compared to 10 years ago, where it was so hard to gain access to. Of course, it was uncorrelated. Like right, you needed to, send a check to some exchange, offshore and hope you get Bitcoin back. you're not going to get correlation when it's when that's how you're accessing it, right? But today, it's 24/7, accessible everywhere. And so when there's moments of high vol or moments of like stress in the markets, crypto is one of the most liquid products you could get out there. So you're going to get that correlation, but you're also seeing uncorrelation in moments of, like, for example, when the war struck or when Silicon Valley Bank went under, like all of a sudden people are looking for that flight to safety. Now, with that being said, these are the activities that create convexity. So it's a high liquid global asset class, traded 24/7, but still in disconnected markets. And so if you are a barbell type portfolio constructor, if you're saying, look, I want something super stable and I'm going to take a 5 to 10% shot on something that may go to zero, like a call option or a venture portfolio, but has tremendous upside, then we consider crypto in that convexity bucket.
Okay.
I'm not here to say that it's going to go to zero, but what I'm saying is your downside's capped to your portfolio size, right? But it has tremendous upside when you have those moments of adoption, which could really super juice a portfolio. And so we look at that in terms of, like, if you are a barbell type portfolio allocator, most people who build those types of portfolios are 5 to 15%. I'm not saying it should be all crypto, but then you start looking at adding a liquid position of crypto into that bucket, right? On the flip side, if you're more a thematic portfolio constructor, saying what are the trends, and I want my clients into themes that are going to have longevity, I keep saying picks and shovels. I know it's not data centers, it's not power, but in the end, it is protocols. Right? It's a new asset class, but it's fundamentally technology that's powering the next generation of financial services. So instead of wondering what's the next company or what's the next product, bring it down to the protocol level. You can invest in picks and shovels. So these are the two ways we look at it in terms of injecting it into a portfolio and in terms of, like, how to treat it in terms of where you take the money from.
Yeah. Okay. You've had a front row seat in your experience. You've been a global leader. You've looked at it from Canada, the U.S., European perspectives. If you could look forward 5 years, like, where do you think the financial system is headed? And I know there's somewhat of a bias because of what you do, but you've also looked at it from an area that neither myself or probably many people in this room have viewed it. Yeah. So where do you see this going? So
there's definitely two trends that we're seeing. One is the creations of super apps, right? So part of Coincheck Group, we're a public company, so I'm looking at next generation companies all the time. We get pitched for investments all the time, potential M&A. But when I talk about super apps, I'll give you an example of a company that just went from 0 to $1 billion real fast. I won't name the name, but essentially what they've built is a cross access of investable capabilities. So they started in crypto, spot crypto, then they added crypto derivatives, then they added tokenized securities, and then they're adding perpetual derivatives on top of that. So all these new sort of derivative products were built in the crypto world. They're called perpetual derivatives, but they're essentially a technology that's being adopted to create derivatives around anything and everything. Right? That is becoming a massive trend. And so these super apps are allowing individuals to have leverage, cross margin, and tap into your equities, your crypto, your derivatives all in one. And so you're getting a lot of choice, a lot of leverage, cross marginable. So I see that as being a world where the more retail uses that, the more the world will continue to be volatile, not just from a macro perspective, but when you add leverage and cross margining on anything and everything, you're going to have auto deleveraging, you're going to have cascading deleveraging events, and that's going to have cascading events in more markets. So you had some speakers talk about they see the world becoming more volatile. I would see that as well with where the technology is driving investments. And at the same time, you have sort of the sentiment of, I don't have time to wait for 5% a year compounded. Like, there's just more of it's not me saying that, it's just the younger generation saying that. They're looking for the big bets, which is why you see sort of zero DTE increasing. You're seeing poly markets and Kalshi, like basically just essentially bets on anything and everything, sports gambling, those kind of things. It's not investing, it's gambling, but that is also a trend that's happening. So we have to; those are things we have to look at as an industry to say, like, how do we either offer products or education or things that make them feel that they have a future, that they can invest in something that we feel are true investments, but that show them that they have a future without having to take all these bets or the continuous ups and downs of trading. Because that's what I'm seeing the apps and the providers starting to offer, is these quick potential solutions. And we're seeing sort of a whole population getting away from the world that we know and have built. And so there is this disconnect that's taking place.
Yep.
So how do we adapt as an industry to service that new market in a way, in a philosophy that we believe, which is why I think that the advisors will have a huge continued role to play. Because you're going to have access to more and more products. Yep. You're going to have AI, which is going to give you access to more and more information. But there's still the human element, right? What do I pick? How do I react in downtrends? Who do I talk to build a plan for the future? That's hard to do alone, and so we have to adapt. And that's where the world is going. We call it BlendFi, right? Yeah. So our parent company in Japan is Monex Group. We're the crypto side, and internally we always talk about BlendFi. It's like, how do we create a dual visions, because these two worlds will merge in the next 20 years somehow. And so how do we position ourselves for that?
I mean, the allocations right now that are being recommended by some of the bigger wealth managers, I mean, they're still modest, right? I mean, 1 to 5 from a JP Morgan perspective. There's dealers here in Canada that actually in discretionary models still don't allow the positioning of the asset. Yeah. Well, in your opinion, where are they getting that wrong? How does that thinking need to evolve to feel more comfortable about the space? And I mean, I said I'm not going to go down the road of cryptos for money laundering and ransom payments. Yeah. I think we're way beyond that, right? But from a dealer perspective, there still seems to be some caution.
Yeah. So let's break it down to the fundamentals, right? So people are using crypto or digital assets. Let's break down to the 3 types, right? Because that's very important from an education perspective. In the next 5 to 10 years, everything will be a digital asset. What do I mean by that? Everything will sit on the blockchain, right? The way regulation, whether it's MiCA or in Canada or others or Clarity Act, they treat the cryptos in 3 different ways. It's either a crypto for payment, stable coin, right? It's either a tokenized product. In other words, it's something that's been digitized. So take one of your credit funds, right? That may be illiquid, that may be for credit investors only. And how do we digitize that so that it's more easily accessible for onboarding, KYC purposes, more potentially liquid, and more easily distributable, right? So regulators see that as just a pass-through to the fund. So whatever the fund is, whatever risk rating it has, it will have the same in its digital form. So that is now pretty much common. And so you're just investing in a digital asset that happens to be a tokenized version of that fund, which is great because now you're going to have access to a lot more things. And then there's what I call the picks and shovels infrastructure, or the protocols. Your Bitcoins, your Ethereums, your Solanas. So when we talk about our product, the DXMC together, we're talking about that, the picks and shovels, right? And so at that point in time, you have to determine, right, the picks and shovels, it's a new protocol, it's a new technology. How heavily weighted are you in technology? Everyone's concentrated on the AI bet. Maybe you want to diversify away from the AI bet. Well, you may want to start looking at financial technology, and crypto is that. Number 2, you may be looking again for convexity in your portfolio, right? Ventures, hard to get access to, picking the right manager, right? Ventures, more and more complicated. Crypto still has room to run because it's still not fully adopted, or to your point, fully understood everywhere. And so there's still that convexity to it. And so again, not saying or recommending to go above 5%, but fundamentally, if you're that kind of technology investor, picks and shovels investor, or looking for convexity, you should be exploring potentially a higher allocation if it makes sense for you, or at the very least start exploring what a 1% allocation will look like in your portfolio.
You guys have a lot of institutional experience. Yep. Can you talk a little bit about how institutions have been allocating, like with your guidance?
Yeah. So fundamentally, they treat it this way. So they look at Bitcoin more as the macro hedge, right? So a lot of sovereigns and institutions may look at gold and saying, okay, what's the next level? And we're comfortable with Bitcoin. And the ETFs changed the game. Like, we have worked with or know a lot of sovereigns. We have sovereigns as clients now in the private side of our crypto hedge funds. But fundamentally, what they were looking at was a vehicle that's regulated, because it was either a operations diligence risk, like how do we get a custody of this, how are we going to have governance around this, versus does it make sense as an investment. So once the ETFs came in, it became an easier investment choice. So number 1, you're seeing the advent of, or the growth of IBIT, you're seeing the growth of MicroStrategy, because they're bets. And the 2 reasons why is IBIT is the most liquid Bitcoin ETF globally today, right? So institutions are going there for Bitcoin exposure if they just want Bitcoin, and they're going to MicroStrategy if they want sort of a convertible, option, right? So you're going to go into a zero fee bond, and if MicroStrategy or Bitcoin goes up, they'll convert into equity. If not, they get their money back, and so they're kind of playing a downside protection game that way for crypto. Then you have others looking for how do we capture alpha from the space? Because it's volatile, because it's disconnected. So a lot of them are looking for market neutral strategies. There's very common trades that are yielding very interesting opportunities with zero leverage in the space. So they're playing it that way. We're enabling them to enter that space. And then finally, others are looking at the picks and shovels angle, which is what we've built with DXMC, saying we believe in the trend where this technology is going, and so we want to invest in the infrastructure of tokenization, and so we're going to invest in Ethereum or Solana or other blockchains.
Okay.
Those are the three big macro themes that institutions and sovereigns are how they are evaluating and studying access to crypto.
Okay. Yeah. If anyone has a question they want to ask Pascal, just throw your hand up. I'll try and or you can catch him at lunch. One of the things that attracted us also to you is we said this is going to require education, and starting with us as a manufacturer, 3IQ built a proficiency program that all of our sales and distribution team members had to go through and pass. So they are competent when you are deciding to talk to them, but we also have a lot of participation from 3IQ at an advisor level to have a more detailed conversation about allocation. One of the things about, and I'm I guess really more focused on Bitcoin, I think for people that aren't used to the space, it's the swings in the value of Bitcoin, the price of Bitcoin. Like, how do you cut down that noise? And maybe DXMC is a way to do it, get a well-diversified exposure, but it is hard to ignore the pricing aspects.
Yeah. So, full disclosure, DXMC is not vol controlled, right? So it's diversified in terms of what you're getting access to, but even the equities have a swing. So we'll just talk that way. So you have to be comfortable with the beta aspect of this, but that's the convexity portion. There are other products that will give you sort of that downside protection, but capture a portion of the upside. So you can manufacture results because there's so much volatility from that perspective. But let's think this thing through. Why I think the whole world will become more volatile, not just crypto. We have to get used to that or adapt our portfolios to that. Number one, when we study, we look at inflows and we look at leverage in the crypto system, and because it's blockchain, super easy to see.
Right.
It's all transparent. It's all accessible, right? So when we see institutional flows into ETFs or into spot, you tend to see a up and to the right, steady as she goes sort of price action, because these are long-term holders and they're buying it for that long-term play. When we see Bitcoin being used as collateral for some of these super apps, because they are, it is. It's not like if they're trying to trade Bitcoin. It's the Bitcoin is being used as collateral to leverage, on these derivatives, and in some countries you're getting, I'm not kidding, 50x leverage.
Right.
So I'm not talking 1, 2x. I'm talking, roll the dice leverage, right? So you can't go to bed because a 2% swing, and and these are all auto deleverage. So when we see the derivatives basically leverage up, and you could track that on the blockchain, then it's pretty obvious you're going to start seeing a potential downswing in Bitcoin. Not because there was anything wrong with Bitcoin, not because there's any threat to Bitcoin. It's been used as a liquid, collateral by people who are taking big bets with big leverage. It has nothing to do with crypto. It's just liquid. And so when these things deleverage, it's auto deleverage, and there's a cascading effect. And so this is what's driving volatility in the markets. The more institutions and retail adoptions through advisor networks and others adopt it, the more you're going to see that up and to the right and that dampened volatility. You have seen that this year. You're seeing swings, but not. There was a moment where Bitcoin was, people were saying a boring low vol asset compared to what was happening, right? We saw it in gold and silver as well. I mean, gold went on a rip, and then one morning I woke up and silver was down 35%. So, I mean, I think just we're entering that world, and it has to do with these super apps and with everything leveraged all the time, 24/7 trading globally. That's just the reality of the markets.
Yeah. This goes a little bit beyond our scope, but
Sure.
I mean, it's pretty hard not to be hearing about how major global banks are thinking about tokenization and the impact that's going to have on them. Can you touch a little bit on
100%.
where this is headed and how it's going to impact the broader global financial
100%.
system, especially banks?
Yeah. So if we got to think about about how, it's all about distribution. So how do you grow AUM as a business? It's about distribution, and so there is a world where you're seeing a trend to bring some of these alternatives. So the portfolio theory you spoke earlier is making its way into the retail space, right? So we saw the same study when we looked at institutional portfolios or the global macro portfolio, the GMP or others. There is a shift from a traditional 60-40 to a 60-40 where it's 60 equities, 40 alternatives. There's just a shift to diversification. And as portfolio theory progresses and as retail want more access, we have to change. Regulations are starting to shift to do that. So tokenization is the next sort of wrapper that allows these types of products to make their way into the retail platform. You have all these new fintechs and these super apps that are built natively on blockchain. So even if you build an ETF, they're going to tell you tokenize that ETF because we've built our whole tech on this new platform. So the only way to get your product onto our platform is going to be by tokenizing it. So even if you're an ETF, you're going to have to tokenize it, which is why BlackRock is starting to tokenize and test most of their ETFs. Even though it's accessible in North America and in a lot of countries, it's much easier to tokenize and distribute BlackRock products in emerging markets through these super apps than to try to get a new ETF listed in an emerging market where it has an illiquid exchange. We have a big business in the Middle East, and the reality is the ADX, the Abu Dhabi Exchange, from an ETF perspective, has zero liquidity. Right. But their tokenized markets have tons of liquidity. Right. And so if you are a product manufacturer and you want to distribute outside of your jurisdiction or outside of your normal platforms, and you want access to retail platforms and to emerging markets, you have to tokenize.
Okay.
That's why all these institutions and these banks are testing, because they realize that these new platforms are being built on blockchain, and if you want distribution into emerging markets, it's going to be blockchain.
Okay.
Yeah.
I promised to land this on time, and we're almost at time. Were there any questions that anyone wanted to throw to Pascal, or you can always grab them at lunch? But with no questions being asked, I mean, this is conversation number one. We know there's a big educational curve, and we're happy to play a role in that. Information on DXMC, but on the broader digital asset space, we have a resource center on our website. You guys have been tremendously involved with our sales team in the education and the process there. So, we appreciate the work that's gone into this so far. We consider this part of our alternatives footprint now, and it's a covered area by associations like AMA that are treating this as part of the alternative, one of the legs in the alternative stool. Yep. Which is really encouraging. So I want to thank you for your partnership. Thank you for your time. Maybe if you'll indulge me, I'll wrap this up really quick.
Of course.
Today, and then we'll head out into lunch. I hope you found the last couple of days useful, tangible, applicable to your portfolios. We hope that more than anything. And if you could just throw that slide up on screen for me, Rick, that I think we had done today. My good friends at Pickman Mahoney did a little bit of marketing for us today. They just released their State of the Liquid Alternatives Market in Canada. And if you're not aware, the legal entity for Dynamic is 1832 Asset Management. So please don't take a picture and send this to Dave or Dean Shepard. But we are the market leader in liquid alternatives in Canada. We have 21% market share. For breaking down that chart there, the 11.8 billion is all the Quantamental team with Damien and Derek. That's all premium yield plus that's in that category, and that's thanks to most of you in this room. On the other side are the balance of our liquid alternative mandates, and while we don't discount the fact that digital assets, OM and hedge funds, where we have a long history and level of experience, are going to continue to play a role. You can see what's happening here. There's now 85 billion in AUM in the liquid alternative space in Canada. So having 21% market share and growing, we're very thankful for the opportunity to continue this conversation with new emerging asset allocation opportunities. On the fixed income side, I think, I don't think anybody in this room, including myself, has ever had more fixed income exposure at a due diligence conference. So, but we also know you came down here to hear about that, and I think you've heard the opportunities for diversifying portfolios and where active management can truly make a difference. So we hope you like the format. We'd love for you to tell your distribution partners on the Dynamic team what we could do to improve this type of process. I have one question, so we're going to cut this out of the recording. We know that it was difficult for some people to make the decision, given some of the geopolitical undertones right now, to go to the U.S. We have the luxury of being an asset manager that's owned by a bank that has exposure in a lot of areas where other asset management companies don't have. So my question is, if we were to do an event similar to this, but we were to go to a place like Mexico City, for instance, would there be a level of interest? Because we'd be the only Canadian asset manager that could have a due diligence conference in Mexico. We're not going to go to Cancun or Cabo, so don't ask me that. We happen to have a head office in Mexico City, and I was just there traveling on business for the other part of my job. So if that sounds of interest to you, we're working on that as a potential possibility. So let your wholesale team know that we could come to you for that type of opportunity. So I will end it on that note on behalf of all of us at Dynamic, all of our partners. I started this conference by saying partnership was our most important piece. You've had exposure to our investment management partners, but we can't do this without you. So we appreciate your time, your investment, your support. We wish you safe travels. We hope you had some time to enjoy Los Angeles on the front or back end. We have a to-go lunch, but you're welcome to sit down and join us as well for lunch. But if you have to be on your way, we understand that too. And we look forward to seeing you all very soon. Thank you. Thanks, Pascal.
Thank you so much.
Okay, that was great.